Great. November 2019, question 2B for financial management. Page 39. Maua Horticultural, you're there? So we're told that Maua Horticultural Limited runs a flower export business. The company has two sources of funds at different interest rates. The finance cost for the short-term funds is 20%, and the cost of long-term funds is 25%. These costs are expected to remain constant in the next 2 years. The following are the projected monthly working capital requirements of the company for the year ending at 1st December 2020. So tuko na January mpaka December. The working capital required in thousands of shillings for each of the months. Then for 6 months, the average monthly permanent and seasonal working capital requirements for the company. Now, remember we say that there is always the minimum level of working capital that a company must maintain at all times. That minimum level is known as the permanent working capital. Remember the point, the permanent working capital. So to get the permanent working capital, you look at the question that you ask yourself, how much was the minimum? What was the lowest that we could go? The lowest that we could go in that question is how much? I think that 5,000. So that 5,000 becomes the permanent, the minimum level of working capital that we must maintain. Kila mwezi lazima tuko na 35,000. Ndio. Anything above 35 is now fluctuating. So that will represent the seasonal working capital. So therefore, here the 6 months, you have the month, you have the month, you have the total working capital. Total working capital, you divide it into 2 to have the permanent. Permanent working capital, and you have seasonal working capital. So the figures are 600,000 of shillings. So tuko na January mpaka December, January, February, March, April, May, June, July, August, September, October, November, and December. Copy na paste. Total working capital tuko na 35,000. So permanent is how much? 35,000. How much is the seasonal for January? There is no seasonal. Feb, total is 35,000. Permanent equal happy. 35,000. How much for seasonal? Nothing remains. March, total is 52,500. Permanent equal happy. 35,000. Ibaki happy for seasonal. How much? 17,500. April tuko na ngapi total? 70. Permanent equal ngapi? 35. How much is seasonal? The remaining balance of 35,000. May, we have the total of 105 with the permanent of 35 and seasonal of 70,000. June, a total of 157,500 with permanent of 35,000, external of 100 and what? 122,500. July to 10 for the total. Permanent is 35,000, external becomes 100 and what? 175,000. We have August, total of 242,500 with a permanent of 35,000 and external of 200 and 207,500. September tuko na total ya 157,500. Permanent is 35,000. Seasonal becomes 122,500. 3 to go. October tuko na 87,500 as the total. Permanent is 35. Seasonal is baki ngapi? 52. 52,500. Then of course we have 70 with a permanent of 35 and seasonal of the remaining 35. Finally, it's gonna 52,500. Permanent is 35,000. Seasonal becomes 17,500. So after that, they wanted us to get the average monthly, permanent, and seasonal working capital. So average, we get the totals. It's get that 5,000 times 12. That 5,000 times 12. This for 20,000. Nazo kahadi hii. Alafu tuongeza kwa hii tupate hii. Question is November 2019. November 2019, question 2B. How much? 300. 855,000. Like that. So we add to this, what is the total? 1272. So they wanted us to get the average. The average permanent working capital is it for 20,000 divided by 12? We get 35,000. And for seasonal, we have 855,000. We divide by what? The 12 months. Giving us an average of how much? 71? 71 to 50. Unapata max theta. So let's get the next 6 marks. The next 6 months, you're being asked to get the total cost of working capital finance for the company under an aggressive financing policy, conservative financing policy, and matching and matching financing policy. Now, under aggressive, we use short-term funds or long-term funds. We had the three financing policies: aggressive, conservative, and matching. Aggressive tulisema tunatumia hata aggressive, we use the short-term funds. We are so much aggressive such that we don't fear risk. We don't fear risk. And if we don't fear risk, we shall comfortably use the funds that are highly risky. And the financing that is highly risky is the short-term financing. So the aggressive policy, we use the short-term funds. Conservative policy, we use what? Conservative risk. So we use the long-term funds. Aggressive, short-term funds, conservative, long-term funds. Matching, we match funding with the assets that are being financed. So we can start with the, so for aggressive policy, we use the short-term funds. And remember, the short-term funds will finance the entire working capital. So in our case, our total cost, we'll take the total cost. Do you have the cost of short-term funds? I think 20%. So it will be 20% of the total working capital, 1272,000. To 54,400. That is for the aggressive. Conservative. For the conservative policy, we use what? We use the long-term funds. So total cost becomes what? We have the cost of long-term funds, 25%. 318. Then for matching policy, we now match. The long-term funds will finance the long-term assets. The short-term funds will finance the short-term assets. Short-term assets need less possible. The long-term assets is less permanent. So therefore, the long-term funds, the cost of long-term funds is 25%, and we're financing a total of how much? 420,000. Then short-term funds, whose cost is 20%, will finance a total of how much? 855. So the cost of long-term funds, how much? 175. 105. Get long-term. I love short-term. 171. 171. Total cost 276,000. And you get your 6 marks. Then after giving you the 12 marks, they want you to advise the company on the appropriate working capital financing policy. Which one is appropriate? Matching, aggressive or conservative? You advise based on the solution. Are you happy with the low cost or the high cost? You're happy with the low cost. But the best is what? Aggressive. So aggressive policy is the most appropriate. hivyo tu. Aggressive policy is appropriate. Aggressive policy is appropriate, as simple as that. Aggressive policy is appropriate. So receivables management. Then we can say receivables are affected by the annual credit sales. Receivables are affected by the annual credit sales and receivables period. Are affected by the annual credit sales and receivables period. Receivables period is also called average collection period. And into brackets, average collection period. We collect from our debtors. Receivables is about debtors. We collect from our customers, those are the debtors. For payments, for payables, that's the average payment period. So we pay to our suppliers, we collect from our customers. So average collection period, i.e., tumwambie kwa receivables equals. Unaweza kumbuka ile swali tulifanya last time. Ili tupate debtors, tulichukua the annual credit sales for SES. Divide by 12. Divide by 12 to multiply by the receivables period. If it is in months, but if it is in days, then we shall divide by 365 and we multiply by the receivables period. This one, if the period is in what? Is in days. If the period is in months, the way zile masile swali tulifanya 2020 ilikuwa tunachukua sales and divide by 12. Multiply by the positive 2.5. Customers were taking 2.5 months to pay. So tukachukua the annual credit sales, divide by 12, multiply by the receivables period ambayo ilikuwa in months. Kwa ile swali tulifanya, right? So if the period is in days, you divide by the number of days in a year. If the period is in months, you divide by the number of months in a year, which are 12. If the period is in weeks, we shall divide by the number of weeks in a year. Examiner will tell us 50, 52, 54. Examiner will guide us. The next point to say this. So SES is the annual credit sales. So I continue by saying the management can influence the level of credit sales. The management can influence the level of credit sales, comma, receivables period, and consequently, the average receivables, through a change in the firm's credit policy. So if the management changes the credit policy of the firm, it will affect the amount of credit sales. It can also affect the receivables period. And what is the consequences of that? When we affect our sales, we affect our receivables period, which shall automatically affect our debtors. So the management can influence the credit sales, the receivables period, and consequently our receivables through a change in the firm's credit policy. The next point is saying the term credit policy. The term credit policy is a combination of three variables. The term credit policy is a combination of three variables. i.e., number one, credit standards. Credit standards, that is, procedure put in place that a customer must meet. Procedure put in place that a customer must meet to qualify for credit. So what are the standards? What are the credit standards of credit put up by the company? So which a customer must meet to qualify for credit. Full stop. Then you say, when the standards are strict, the level of credit sales, when the standards are strict, the level of credit sales, bad debt losses, and average debtors shall be low. And vice versa. So kama tumeset standards ambazo ziko very strict, credit sales zetu zitakuwa kidogo, debtors wetu watakuwa chache because very few people will qualify for credit. Sales pia zitakuwa kidogo, and of course the bad debts pia zitakuwa kidogo. Because the few that will qualify for credit will not be able to forfeit. Our bad debt losses zitakuwa kidogo, credit sales zetu zitakuwa kidogo, debtors pia watakuwa chache, because for you to qualify, lazima uko meet those strict conditions. So the few that will qualify are the customers that we are sure they will not let us down. So of course, if they're so lenient, the opposite happens. Number two, credit terms. That is, the credit period offered to customers, including any cash discount, e.g., credit terms of you can have 3/15 net 30. What does that mean? 3/15 net 30. A good trial. You take your calculator, start doing 3 divided by 15. Alafu net inakuwa plus or times. Awachana na calculator. Calculator tutanganya. So hii inamaanisha kuwa ukilipa na 15 days unatoa discount ya 3%. Pay within 15 days to enjoy a 3% discount. If you can't manage, then don't go beyond 30 days. That's how. For the customers who pay within 15 days, they'll enjoy a discount of 3%. The remaining customer should pay within 30 days. So the credit terms of 3/15 and 30 means a 3% discount. A 3% discount is given to customers. A 3% discount is given to customers who pay within 15 days. Is given to customers who pay within 15 days. While the remaining customers should pay within 30 days. While the remaining customers should pay within 30 days. Then number 3, collection effort. Collection efforts. That is collection effort, i.e. procedures put in place for dealing with overdue accounts. Procedures put in place for dealing with overdue accounts. Do you know overdue accounts? The accounts that remain outstanding after their due dates. Tulisema kuwa kama hauta qualify for discount, usipitishe 30 days. Now umepitisha 30 days. We need to have a procedure in how to deal with you. So that is the collection effort. So procedures put in place for dealing with overdue accounts, including reminder letters. Nazaandikia barua. Reminder letters, personal visits. Personal visits, mails, email, phone calls, factoring, What do you mean by factoring? Factoring, you start talking about factors to consider. Then the alternatives, that is factor. Now, factoring, you ever heard of these people called debt collectors? The debt collectors, you've heard of them. And by the way, CASNEP has a course of them. Are you aware of that? The CCP. CCP is what you call? Something there. Certified credit practitioners. Now, debt collectors, hiyo jina mtaani. So wacha kuita debt collectors, kuita financial term, wanaitwa nani? Factors. And factors are not individuals. Factors are companies that exist to help other companies recover their debts. So factoring is simply use of goods. By the way, naandika debt collectors for your own for easy understanding. Lakini kwa exam ukiandika debt collectors itakunyorosha. Finance tuko na jina zao, wanaitwa nani? Factors. Factors. And they're very qualified people. And what happens with these factors? You transfer all your debtors to this new company. And this new company promises you, once you sign an agreement, we shall maybe give you 80% of what you're expecting. That's a good deal. So nakwambia wacha kungangana na customers wako tupe hiyo kazi. Immediately tuna sign contracts. Kama ulikuwa na debtors were like 5 million, we are going to give you 80% of 5 million. That's a good deal. So we give you the 80% of the 5 million, the remaining 20%, you give us some time to collect and give you. So it will be now our responsibility to collect the 100% of those debts. recover our 80% that we gave you and give you the balance. Sasa, and of course, hiyo advance tunakupea iko na cost yake na pia sisi tunacharge commission. So the risk is that you are losing your customers. Ili watu wapate hizo pesa kwa customers, watu wa frustrate. Yeah. They can even auction them. So once you transfer your customers to the partner, then chances are high you no longer have them. That's why many companies prefer to deal with their customers on their own. So, and as a last resort, let's conclude that. And as a last resort, that resort in a tunasema option. And as a last option, I'm a last resort, legal suit. Hiyo ni option ya mwisho. Because customers ukishapeleka kotini, si hao washakutoka. They'll never come back. They'll never come back. Great. You can skip one line, then you say. We prepare a cost-benefit analysis. We prepare a cost-benefit analysis to evaluate the effect of a given change in a credit policy, the effect of a given change in credit policy, the effect of a given change in credit policy to the firm's profitability. So how does a given change in credit policy affect the firm's profitability? Full stop, then you say, increase in current assets leads to an increase in opportunity cost. Increase in current assets leads to an increase in opportunity cost. While increase in current liabilities leads to a decrease in opportunity cost and vice versa. While an increase in current liabilities leads to a decrease in opportunity cost and vice versa. So current assets zikiongezeka, opportunity cost inaongezeka. And it's very practical. When stock increases, inamaanisha kuwa I'm not saving cash. I'm using the cash to buy the stock. So cash is invested in stock. Cash is staying idle in stock. So the cost, the opportunity cost, the return for a goal, the opportunity cost is going to increase. When current liabilities increase, like now our creditors wakiongezeka inamaanisha kuwa I'm not paying them. And if I'm not paying them, that means the money that I would have otherwise spent to pay my creditors, I'm going to use it somewhere else and get a return. So increase in current assets, increase in opportunity cost. Increase in current liabilities, decrease in opportunity cost, and vice versa. Let's get a question and do. We can check on the FOF for today. And check FOF. It was tested even last sitting, question 4. Question 4B. Last setting, page 2, April 2023, for fundamentals of finance. What do you think are the 3 reasons why it is not advisable for a company to use the bank overdraft as a short-term source of finance? So disadvantages of bank overdrafts. Is it highly risky? It's a short-term funds. The short-term funds are highly risky still. So one of the reasons as it is not advisable to use the bank overdraft is that it is highly risky. Question 2. Question 4, sorry. Page 2, question 4. Mbona tupatie tukaanza kuijibu? Umeipata? Yeah. Page number 2. Tuangalie basi kwa group. We're just asking ourselves on part A, the reasons as to why it is not advisable for a company to use the bank overdraft, the common disadvantages of using the short-term funds. The bank overdraft is highly risky. That's one of the reasons. Any other? It has a fixed rate of return. So its return is fixed. So it has a fixed rate of return, it's highly risky. Then of course it's affected by the government policies on the minimum lending rates. It's affected by the government policies on the minimum lending rates. So wakiongeza interest rate ya bank overdraft itaongezeka. Wakipunguza itapunguka, but many companies don't reduce, right? Many banks. And of course, different banks charge different rates. That's also another disadvantage. There is not a predetermined interest rate. So banks can take advantage of that to exploit their customers. So it's just reasoning around that. Now, part B was our interest. Karibu Limited has annual sales of 12 million and all sales are on 30 days credit period, although customers on average take 10 days more than the credit period to pay. So customers take how many days to pay? For your English, is it 40? Ile terms ya kampuni ilikuwa customers walipe na 30 days, but for ground vitu ni different. Customers will take 10 more days. So our period becomes 40 days, right? Additional information, the company's gross margin on sales is 40%. The company currently has no bad debts. Account receivables are financed using a bank overdraft at an annual interest rate of 7%. The management has plans to offer an early settlement discount of 1.5% for payments within 15 days and to extend the maximum credit period offered to 60 days. So that's the same as 1.5 over 15, net 60. Sindio? Discount ya 1.5%, wale wanalipa na 15 days, wale wengine kufikisha 60. The management expects that these changes will increase annual credit sales by 5%, while also leading to additional incremental costs equal to 0.5% of sales revenue. So kutakuwa na costs zingine hapo. The discount is expected to be taken by 30% of the customers, with the remaining customers taking an average of 60 days to pay. Assume 365 days in a year. For 8 months, evaluate whether Karibu should adopt the proposed changes in credit policy. So let's see. So we simply prepare a cost-benefit analysis. So we look at current policy. We compare the proposed policy. Then we find out if there is any additional benefit, the cost. Cost is in brackets. By the way, hapa ni kutengeneza income statement. We can have them in thousands of shillings. Just preparing the income statement. Can we have our sales? Currently sales ni ngapi? So 12 million, that is 12,000. Right? With the proposed policy, wamesema sales stay increase by what percent? 40%. So how much will be the 40% the gross profit? Sales will increase. This will increase annual credit sales by 5%. So all sales are on credit unless otherwise stated. So sales zitaongezeka na 5%. So how much will be the new sales? Note number 4. Kiongeza 4% for 12, how much? 12,600. So meaning sales zimeongezeka na ngapi? 600. When sales increase, are we happy or we are sad? We are happy or we are sad? We are happy. So that's the benefit to the company. That's the benefit to the company. We are supposed to less the variable costs. But remember the gross profit, the gross margin. That is our gross profit. So therefore, gross profit to get less variable cost ama cost of sales. Lakini tumeambiwa gross profit on sales is 40%. So 40% of 12,000. $4,800. 40% of 12,600. 50-40. So that gross profit iongezeke na ngapi? 40% of 600 to 40. Ama this minus this. Ndio. Remember, forward never, backwards never. Tutengeneza income statement, tuko na sales, tumepata gross profit, tunaendelea mbele. Kama tungekuwa cost of sales, tungeless cost of sales, tupate gross profit. Sasa less expenses. We have walisema there's when also leading to an additional incremental cost. So you have the additional cost. That will be 0.5% of sales revenue still. So just follow the instructions. 0.5%. How much will be the sales revenue? 12,600. Baada ya kuongeza sales na 5%, tutakuwa na cost itaongezeka ambayo itakuwa 0.5% ya hizo sales. Still getting it from note number 4. So that's the cost that will come with the proposed policy. How much is that cost? 63. So that cost, are we happy? We are not happy. Cost is going up. Cost is going up. What else is there? Did we have a discount? It's a discount in cost. So have discount, cash discount. Currently, are you having any discount? Under the current policy, there is no discount, right? What was under the proposed policy? What is the discount rate? The discount rate. 1.5% is the discount rate. Yeah. Exactly. But the rate is 1.5%, which will be taken by 30% of 12,000 gapi. 600. So it's only 30% that will enjoy the discount. So the cost as a discount will be on the 30%. And the discount rate is 1.5%. As long as it's not syntax error. 56.7. And that is the cost. Currently, haiko inakuja na new policy. So we are not happy with that. So therefore, we lose 56.7. Cash is going out, we are not happy. Any other expense? Do you have bad debts? Hatuna bad debts. The company currently has no bad debts. There are no bad debts. So at that point, we have pre-tax cash flows. Hii ya mbele ndio yenye tunataka peke yake. Hizi za kusaidia kupata wake. Tumesema tuna carry out the cost benefit analysis. So we have these are what our interest. So 240 minus 63 minus 56.7. 600 share dollar. Tulianzia kwa sales tukapata gross profit. Others the sales minus cost of sales tupate gross profit, tuendelee mbele. Kwanza kurudi tuna kwa 600. Forward ever, backwards never. 120.3. Kama tungekuwa na tax rate, tungeless tax. But tax rate haiko. Then we bring in something called opportunity cost. Hiyo ni ya current assets and current liabilities. There is always one current asset yenye examiner huwa inakuwa na feature, na hizo ni debtors. So tunataka receivables. Receivables, let's have the working somewhere. To see squeeze hapo sana. Just a little space for the working of receivables. So tunamwambia kuwa tuko hapa na working ya receivables. And we know that receivables equals to annual credit sales divided by what? Metuambia tumia 365 ndio times the receivables period. Ndio. Tuanze na current policy. under the current policy, how much are our credit sales? I see 12,000. Sales is here. We divide by 365. How long does our customers take to pay? 40. Under the current policy. So let us know that. $13, $15. So hizo unaleta hapa kwa current policy. Then kunaenda kwa proposed policy. Now kwa proposed policy, we're very careful na discount. Tuko na two types of debtors. Kuna wale wa kwanza wenye watakuwa na discount. With the discount, what percentage of customers enjoy the discount? 30%. 30% of how much? Of 12,600. Thank you. Will enjoy the discount by paying within how many days? Within 15 days. So period is only 15 days. Receivables period. So how debtors wakuwa ngapi? What? 155. Alafu kuna wale wa pili wenye hawana discount. If 30% enjoy the discount, tulibakisha wangapi? So the remaining 70% of our customers did not enjoy the discount and paid within how many days? 60 days. $49. So totally ya data sikwe ngapi? Take that thing. 29, 19, 29, 19. So hiyo unaleta hapa. Debtors wameongezeka ama wamepunguka? Currently 13, 15. With the new policy watakuwa? New policy. New policy? Where now? The difference is this plus this. 1604 is the 2. 1604. When we are in 1604. Back to the question. Wanaongezeka wanapunguka? Wanapunguka from 1315 to wameongezeka wewe. Wameongezeka ndio. Na debtors wakiongezeka, are we happy? We cannot be happy when debtors are going up. Why? Because customers are not paying. And that's why if you're not happy, by the way, we are not looking for the debtors, but we're looking for the opportunity cost. What is the cost of capital? Namara ilituambia 7%. Account receivables are financed using a bank overdraft at an annual interest rate of 7%. So if debtors are increasing, inamaanisha kuwa I don't have that money. So I need to go and get a bank overdraft at a cost of 7%. So therefore, we do times 7%. So it's an increase. So get the difference, multiply by 7%. 20.23. Good or bad? Debtors are increasing, we won't say that we're not happy. That's the cost to the company, still. So therefore, we have a net benefit or a net cost. So 120.3 minus 20.23. Back in a 100.13. 100.13 is here. So you're remaining with the net benefit, not a net cost. So what advice would you give? Evaluate whether Karibu should adopt the proposed changes in the credit policy. Should Karibu adopt the proposed changes? It should adopt. So we are happy. Yeah. So currently, so the change in the credit policy will also affect our debtors. Currently, tuko na debtors for 1315. When we change our credit policy, then we introduce a discount, our debtors will increase from 1315 to 1604. Kuna wale debtors watachukua discount, so you're still selling on credit. So wale wa discount ni 155, wale hawatakuwa na discount ni 1449. So with the new changes, with the new policy, our debtors will be 1,604. Before the change, they were 1,315. So debtors currently took on 1315, with the new, under the new terms, utakuwa 1604. So we can all appreciate what debtors are going up. And when debtors go up, we're not happy. So it means that our customers are not paying us. And if our customers are not paying us and we need that money, we have to go outside and borrow. And we can only borrow at a cost of 7%. So we are not interested with the debtors. We are interested with how much are we going to spend to finance that effect of debtors. And that's why we did call it debtors. We called it what? Opportunity cost. The return for a goal. The return for a goal. So we get the debtors and we multiply by the cost of capital. So debtors is only helping us to know how much will be the opportunity cost. Reduce the benefit. Tutafanya to multiply by 7%, lakini hapa itakuwa plus. Increase in current assets, increase in cost. Decrease in current assets, decrease in opportunity cost. The opposite for current liabilities. Yes. Yeah. 07. $145. So tunaongeza the 25 to 120. So the next, kama hapa for instance, hii figure ingekuwa kama hapa ingekuwa 18. So ingemaanisha currently tuko na 1815, with the new policy itakuwa 1604. Si debtors wamepunguka. Na debtors wakipunguka tuko na furaha. Tukiwa na furaha, we are saving. So it means that our customers have paid us. And if customers have paid us, then you are not going to spend the 7%. You are going to save the 7% that we could have otherwise spent. Kama tungekuwa na hiyo pesa, wametulipa tuko na hiyo pesa. Sindio? So it would be a saving in opportunity cost. Na hapa ingekuwa positive. So that now we do 120.3 plus 20.3. Sasa, yeah. Tunapata the net effect hapo. Nirudishe vile ilikuwa kwanza. Because of documenting. So 13. Nashtukia umekopa vitu zingine.